This chart shows the steep, historic devaluation of the Nigerian naira against a stable US dollar baseline. With local currency volatility reaching these levels, earning in USD has become a mandatory survival strategy. But the popular approach is broken. A massive portion of the retail market treats Forex as a get-rich-quick side hustle. They fund accounts through unverified peer-to-peer crypto exchanges and chase multi-level marketing schemes promising impossible monthly returns. In 2024, the Nigerian Securities and Exchange Commission abruptly closed that gap. They released a new regulatory framework specifically targeting digital platforms and virtual assets, aggressively ending the legal gray area for retail trading. Ignoring these regulations and FIRS requirements pits your trading business directly against the law. You are no longer navigating market risk alone. You are navigating legal liability. To survive this environment, the casual hustle mindset has to go. You must actively construct a 4-pillar, institutional-grade business model. This visual represents the 2024 SEC framework, drawing a sharp boundary across the industry. On one side are illegal, unregistered securities, like signal rooms promising guaranteed returns. On the other side is legitimate spot retail Forex, where you strictly manage your own risk. That legitimacy also requires complying with the Personal Income Tax Act, or PITA. Declaring your global income transforms your trading from a shadow activity into a recognized, taxable small business. Next is the funding pipeline. Relying on peer-to-peer transfers creates a massive compliance gap. You end up paying a hidden tax of 50 to 100 naira per dollar purely on the spread, constantly eating away at your trading edge. Those undocumented P2P transfers also trigger automated banking alarms under central bank guidelines. This frequently results in frozen accounts right when you need liquidity the most. The professional solution is the domiciliar, or DOM, account. Funding your trades via wire transfers from a DOM account establishes a clean, legal paper trail, making large withdrawals mathematically easy to justify to your bank. Holding your trading capital as dry powder in that domiciliary account also protects you from local exchange rate slippage. You lock in your purchasing power before you even execute a trade. When you establish proper legal and funding channels, regulatory compliance stops being a liability and becomes a protective moat around your capital. The third pillar is technical infrastructure. You cannot trade at an institutional level if a local power grid failure or an internet drop kicks you offline during a major news event. Renting a virtual private server physically located near financial hubs like London solves this. Your trading system stays online 24/7, ensuring millisecond execution speeds regardless of local conditions. Locally, hardware like this Starlink dish provides necessary redundancy. By overlapping two separate ISP networks, like a local fiber connection and satellite internet, you guarantee you are never trapped in a losing position during a blackout. The final pillar is your execution engine, your broker. You have to look past the marketing hype and demand Tier 1 regulation, like the FCA or ASIC, which legally forces brokers to segregate and protect client funds. If your trade execution lags, you need accountability. A broker operating with a physical desk and localized support right here in Lagos provides a level of consumer protection you cannot get from an offshore entity. Top-tier brokers also offer Naira-denominated trading accounts. This completely bypasses the 3 to 5% conversion fees usually charged by banks, instantly saving you hundreds of dollars on a standard account. Combining a bulletproof server setup with a locally optimized broker removes systemic friction. You stop fighting infrastructure and start trading purely on skill. This brings us to the final mindset shift. Institutional professionals don't chase 1,000% weekly gains. They optimize for consistency and wealth preservation. This chart illustrates the math behind a Naira-adjusted return on investment. Even if your US dollar balance remains completely flat at 0% profit, a 40% devaluation in the local currency means you have massively protected your real-world purchasing power. The Nigerian regulatory environment is only going to tighten. Unregulated speculators who refuse to adapt will inevitably lose their capital to FIRS tax audits, peer-to-peer scams, or basic exchange slippage. Adopting this precise 4-pillar blueprint changes your operation. You stop acting as a high-risk speculator and begin managing a compliant, multi-generational asset. professional trading requires a focus on structural security. The ultimate goal is to remain legally and structurally robust enough to keep the profits you extract. Check the description to download the Nigerian Traders Compliance Checklist and audit your current setup. Then join FXNX to trade on a fully compliant institutional-grade platform with 0.0 pip spreads.